Every single time you fill your gas tank, you are performing a ritual. A ritual that reinforces American financial dominance. You pay in dollars. The gas station pays its suppliers in dollars, and the oil company pays the source nation in dollars. This seemingly simple transaction is the engine of the entire global financial system. They tell you the dollar is strong because of the American economy. They tell you it's backed by stability and the rule of law. But that narrative is a structural lie. The truth is that the dollar's global power is built on a single, non-transparent, geopolitical deal struck half a century ago. And that deal is now actively being dismantled by rival nations. What if the dollar's dominance isn't based on economic might, but on a secret agreement that is now collapsing? What if the eventual, inevitable collapse of the petrodollar system won't be a slow decline, but a sudden, violent event that triggers an inflationary shockwave, destroying your savings and your retirement fund? This isn't just about interest rates. This is about geopolitical risk, the ultimate financial trap that explains why the trillions printed by the Fed since 2008 and 2020 are now about to flood back onto U.S. soil, causing hyperinflation. Before we reveal the secret pact and the blueprint for de-dollarization, tell me, where are you watching this unfiltered truth from? Drop your city in the comments. And if you are ready to see the mechanism that truly runs your life, hit that subscribe button now. The historical setup for American financial hegemony begins in the early 1970s. The U.S. had just severed the dollar's last tie to gold, ending the Bretton Woods system. The dollar was now entirely fiat, backed only by the promise of the U.S. government. The world panicked. What would anchor the dollar? The answer was found not in Washington, but in the deserts of Saudi Arabia. In 1974, the Nixon administration, led by Henry Kissinger, brokered one of the most significant and non-transparent geopolitical deals in history. This was the birth of the petrodollar system. The illusion was that this was an energy deal. The reality was a financial pact. The U.S. offered military protection and advanced weaponry to the House of Saud. In return, Saudi Arabia, the most influential nation in OPEC, made two critical promises. First, sell all its oil exports exclusively in U.S. dollars. Second, invest the vast surplus profits, the petrodollars, back into U.S. Treasury securities and banks. This deal created artificial, endless global demand for the dollar. Every nation, Germany, Japan, China, Brazil, had to acquire U.S. dollars before they could buy the oil necessary to fuel their economies. This forced demand was the new structural backing for the fiat dollar. Here's a shocking parallel. In the 1970s, the U.S. traded a tangible asset, military protection, for an intangible financial guarantee, which was global dollar demand. Sound familiar? Today, the U.S. trades access to its massive consumer market and technology for global compliance with its financial rules, like sanctions. This foreign demand is critical because it forces the world to absorb the massive U.S. national debt, a structural anomaly that would instantly lead to domestic inflation without foreign buyers. The system worked brilliantly for 50 years. The U.S. printed debt in the form of treasuries, and the world, especially Saudi Arabia and China, bought it with their petrodollars. This allowed the U.S. to maintain low interest rates and high domestic consumption. But the moral hazard was immense. The U.S. became structurally dependent on issuing more debt and maintaining unchallenged global power to enforce the deal. And here's a second shocking parallel. The U.S. created a financial weapon, the dollar, and then used it to punish rivals like Iran or Russia through the SWIFT system. This weaponization is now triggering the system's collapse. Sound familiar? The 1971 severing of the gold standard forced the world to trust the U.S. promise. The sanctions applied today, which freeze foreign dollar reserves, force the world to distrust the U.S. promise, accelerating the search for alternative currency mechanisms. The greed of rival powers and the political actions of the U.S. have now pushed the system past its breaking point. The critical threat that guarantees the dollar's demise is the proliferation of bilateral currency swap agreements and the creation of parallel financial infrastructure. The world is actively designing an escape route from the petrodollar trap. The decision that truly activated this de-dollarization threat was the US's use of aggressive financial sanctions, specifically the freezing of Russian dollar reserves. This action fundamentally proved to every sovereign nation, especially Saudi Arabia, China, and the BRICS Plus alliance, that the dollar is not a safe asset, but a weapon that can be turned against them at any time. The mechanism they're using to escape is not complex. It's simple, bilateral currency swaps that bypass the US dollar entirely. Saudi Arabia now sells oil to China for yuan, which it then immediately exchanges for local goods, or uses through a non-SWIFT payment mechanism. This destroys the foundational premise of the petrodollar. The individual who oversaw the final decisive agreements to price major global energy deals outside of the dollar was not a head of state, but a shadowy oil minister, a man focused entirely on sovereign stability over geopolitical allegiance. You won't believe the name of the figure who guaranteed this de-dollarization strategy, and how much wilder the real story is than you think. Let's delve into the weaponized mechanism that will bring the crisis home: bilateral currency swaps and the forced repatriation shock. The core principle is simple. The collapse of the petrodollar means the end of structural demand for US debt, those treasury bonds. There are 4 stages to the de-dollarization shock. First, the swap bypass. Nations, especially the BRICS Plus alliance, execute bilateral currency agreements to trade oil, gas, and commodities using their own local currencies, like the yuan, rupee, and ruble. This eliminates the need for dollars in international trade. Second, the treasury dump. Nations holding trillions of petrodollars in the form of US treasuries now lack the structural reason to hold that debt. They begin to quietly, or eventually openly, sell their US treasuries. This is the greed of self-preservation. Third, forced repatriation. As foreign nations sell treasuries, those trillions of dollars flood back into the US domestic economy. This is not a slow trickle. It is a massive, immediate return of capital that has been supporting foreign economies for 50 years. And finally, the hyperinflationary shock. This wave of repatriated dollars chases a limited supply of US goods and services. The resulting velocity shock guarantees a hyperinflationary event that will permanently erode the purchasing power of the domestic middle class. Here is a shocking statistic for you. Foreign central banks and investors currently hold over $7.5 trillion in US Treasury debt. This is the capital that will be dumped when the petrodollar mandate fails. The moral hazard is now shifting. It's no longer the banks, but the US government that faces insolvency if its main creditors sell their debt. The illusion of stability is maintained only as long as this $7.5 trillion remains locked overseas. Shocking statistic number 2. The US national debt is increasing by over $1 trillion every 100 days. This relentless deficit spending is only sustainable because the petrodollar system forces the world to buy the debt. The end of this system means the end of easy credit for the US government. The parasitic finance here is that the US has used the petrodollar monopoly to fund 5 decades of trade deficits and massive military spending, effectively forcing the world to subsidize the American lifestyle. Statistic number 3. The US dollar's share of global foreign reserves has already dropped from over 70% in the year 2000 to approximately 58% today. This decade-long decline proves de-dollarization is an ongoing structural certainty. It's already happening. Statistic number 4. China, via its cross-border interbank payment system, or CIPS, has built a direct, non-SWIFT financial clearing mechanism. The CIPS network saw its transaction volume surge past 150 trillion yuan in 2023, a clear sign that the BRICS alliance is moving the necessary financial infrastructure outside of US control. And finally, shocking statistic number 5. Economists estimate that if even 30% of the treasuries currently held by China and Saudi Arabia were liquidated over a 2-year period, the resulting interest rate spike and repatriated liquidity shock would result in US domestic inflation exceeding 20% annually, a level not seen since the 1970s. The structural truth is that the dollar is facing an engineered collapse. driven by the very nations the U.S. attempted to control. The petrodollar's final hour is not about a single event. It's about the systemic failure of the global financial conduit. The historical lesson is that when private profit and public mandate collide, the public always pays the price. The solution begins not with protest, but with awareness. Stop trusting institutions built on self-preservation and begin protecting your own purchasing power. Buy tangible assets, reduce your debt, and understand that inflation is a feature, not a bug, of this engineered system. We are required to deny that the system is structurally compromised. The very debt that fuels the Fed's existence is the chain that binds the American worker. We must ponder this question of our time. Are we wiser now, or are we just walking the same path in better suits? If you believe that history is not just the past, but an actionable blueprint for finance, share this video widely. Expose this hidden truth to your network, and subscribe immediately so we can continue to unpack the hidden mechanisms that control your life and your wallet. Thank you for watching.